Welcome to BG Online Learning. This is the Introduction to Accounting, Session 1, Accounting Fundamentals. We begin with fundamental accounting mechanics. First of all, what exactly is accounting? Well, one definition is the preparation and publication of useful information concerning the financial performance and position of an enterprise. And who exactly is interested in it? Well, you can see from this slide there are a range of interested parties, from customers and competitors of a company to employees and unions, the government, community representatives, investors and analysts, suppliers and lenders to a company, and the managers and owners. The preparation of financial statements is governed by accounting standards. And in Europe, the IASB, or International Accounting Standards Board, is responsible for the development of the IFRS accounting standards. IFRS stands for International Financial Reporting Standards. You can see that the objective of the IASB is to develop a single set of high-quality, understandable, enforceable and globally accepted financial reporting standards based upon clearly articulated principles. The International Accounting Standards and International Financial Reporting Standards are published and have been adopted or permitted in over 120 countries now. And there's a gradual convergence with US GAAP as well. Let's look at what's contained in an annual report of a company. Firstly, you're likely to see the chairman's letter. This is usually a bland letter ending with a big thank you to all of the wonderful employees. For an analyst, there's nothing too much of interest in the chairman's letter. Then we'd see the CEO and CFO reports, the Chief Executive Officer and the Chief Finance Officer. And within those reports, you'll see a review of the business and the financial situation over the last year. Then we would also have the auditor's report. Hopefully there's a clean audit report. That means it's unqualified and the accountants agree that the report has been correctly prepared and show a true and fair view of the company. There might also be a commentary on specific accounting policies that the company's used. You'll see a remuneration report which has all the detail of the director's pay, how much money they received, what share options they have or have been granted, and perhaps information on their pensions. And finally, other business information, reports on corporate governance, corporate social responsibility. If we look at the actual financial statements themselves, we have the income statement, which is revenue less expenses to show profit for the year. We have the other comprehensive income, which shows unrealized gains and losses that affect the balance sheet but are recognized directly in equity and not in profit for the year. Companies these days are sometimes combining these two statements into one. So what you might see for a company is a single statement known as a statement of comprehensive income and expense, which effectively begins with the income statement and ends with the statement of comprehensive income. The statement of financial position is a new name for the balance sheet. And so the balance sheet shows assets, liabilities and equity of the company as at the year-end date. And so we say it's like looking at a snapshot of the company at a particular moment in time. The statement of changes in equity, abbreviated to SOCI, shows the movements in the various components of balance sheet equity over the year. The statement of cash flows shows the cash flows in and out of the company over the last year, divided into three key categories known as operating cash flows, investing cash flows, and financing cash flows. And finally, the notes to the accounts. The notes to the accounts provide much more information and detail, including breakdowns of some of the key numbers on the other financial statements. Next, we'll look at the accounting equation. And you can see the accounting equation if you look at any company's balance sheet. The equation explains why the balance sheet balances. We can see that assets for a company must be equal to the total of its liabilities plus equity. Another way of describing that relationship is that the resources in the company must balance with the claims to resources. Or yet another version would be that uses of funds need to equal sources of funds for any company. Net asset value is another term that you may have heard of. Net asset value is simply a rearrangement of the balance sheet equation that we just saw. Total assets minus total liabilities equals equity, which is the same as net asset value. So for a company, if we have assets of 100 and the only liability is debt of 30, then the net asset value or equity must be 70. And we can also call that shareholders' funds because it belongs to the owners. So if we look at the income statement and net profit next, we saw earlier it's revenue less expenses to give us a profit figure. And the profit, the net profit from the income statement, in fact, adds to the owner's capital, which for a company we'd see within equity. And in theory, that can be paid out as a dividend. Let's look at a real company example. So here we can see the balance sheet of a company. And we start off by incorporating a company, which means setting one up, investing 40 of your own money to buy the shares, which is the equity. And so you see it here in the share capital. Your friend helps out and lends the company 10 interest-free. And so we have a total liabilities and equity of 50. We take those funds and invest in a machine that makes widgets costing 50. The machine will last forever, so if you're familiar with the concept of depreciation, we can ignore it for now. So we have a balancing balance sheet. Total assets 50, matching with total liabilities and equity of 50. And as I mentioned earlier, another way of looking at this is uses of funds, our assets of 50, matching sources of funds, which has come from both liabilities and equity of 50. Let's run the business for a year. Let's say you sell 100 widgets for $1 each, and all customers pay cash on delivery. We've got revenue of 100. You buy raw materials, pay wages and overheads, and total costs come to 70, with all of your bills being paid in cash immediately. You can see you've made a profit, revenues have exceeded costs, and in fact you've made a profit of 30. And let's say you retain the profit in the business as you plan further investments. So let's look at our revised balance sheet at the end of the first year. We now have cash that we didn't have before, and 30 of cash, which is from the profit. The equity has grown because the retained profit belonged to the shareholders, and so it's included in these shareholders' funds, which we saw earlier is just another name for equity. Remember, the bottom line net profit or net income from the income statement adds to equity in the balance sheet, and the particular account it adds to is retained profit. So we can see that the balance sheet still balances, but the values have increased. assets have increased by 30 to 80, and liabilities and equity have increased by 30 to 80. Let's look at the first year cash flow statement. Well, we know that the cash inflow to the company was 30, and so the bottom line on the cash flow statement is a change in cash of 30. But where did it all come from? Well, the operating business made a cash profit of 30, and so we call that an operating cash flow. At the beginning of the year, we bought the machine for 50, which was an outflow and therefore shown as negative. That's an investing cash flow. In the very beginning, the company raised money from you, the equity of 40, and your friend, the debt of 10. Both brought cash into the business, and so they are categorized as financing cash flows. It's the net result of all of them that gives us the change in cash. Well, let's say the next thing is to reward the shareholders. You decide to declare a dividend of 10, which will be paid out of cash. You can see in our balance sheet the cash then reduces from 30 to 20. And the retained profit also reduces from 30 to 20. Because the dividend is effectively a payout of the profit earned by the company. The dividend is also recorded in the cash flow statement as a payment to equity shareholders. It's part of financing cash flows. It's an outflow, and so the financing cash flow is reduced by 10. And you can see the net change in cash has reduced to 20. Finally, don't forget about the statement of changes in equity. This statement shows us for all of the accounts within shareholders' equity, how have they changed over the year. So you can see the very first row there is amounts at the start of the year, which for this company, because it was new, are all 0. Over the year, what happened? You can see that share capital went up by 40. That was the new shares issued. Retained profit went up by 30, the profit for the year, and then down by 10 for the dividends paid. The end value for the year was 20. And your shareholders' funds is just the overall total. Note the more complex businesses might have some other changes that you would see if you look in their statement of changes in equity. So even with that small example, you can hopefully see that everything within those financial statements is interrelated. For example, a company buys an operating asset, like the machine in that example. It has an effect in the balance sheet where we record its value as an asset. It's used to generate profits, which are reflected in the income statement. And you can see that there is a cash impact of when you first buy that asset, which we saw in the cash flow statement. So now let's look at the accounting process. We'll start by looking at accounts and transactions. So companies keep a detailed record of all changes in assets, liability, or equity. And the individual accounts within those categories can be opened and closed as necessary. They will cover a specific period of time. And note that the main account in any category can also have multiple sub-accounts to help record keeping. A transaction is simply an event that affects the financial position of the business and can be measured reliably. The key to understanding how accounting works is this. Every transaction affects at least 2 items. And you may have heard of the term double entry bookkeeping, which comes from this effect. For those 2 items, every transaction will have at least one impact in the balance sheet. The other impact, the second item, may be in the balance sheet or could be in income statement and or cash flow statement. And we'll look at this with a few examples. Note that the accounting equation always balances before and after every transaction. That means the balance sheet relationship of assets being matched equally to liabilities and equity always holds true. Here's our first example. If the transaction affects items on the same side of the balance sheet, you'll see the movements are in the opposite direction to each other. So let's say we buy 100 of office supplies paying cash. Here's our balance sheet. Well, if we're paying out cash, then clearly cash, which is an asset, is going to be shown decreasing by 100. And at the same time, our supplies, this might be inventory, also recorded as an asset, will increase by 100. So we've got two asset accounts being impacted, one increasing, the other decreasing. And of course, the net effect is that the total assets on the balance sheet have not changed at all. Therefore, the balance sheet still balances with the same totals as before for total assets and total liabilities and equity. For our next example, we'll see that if the transaction affects items on different sides of the balance sheet, the movements are in the same direction. So let's say we settle an outstanding trade payable of 200 paying cash. So a trade payable is a supplier that we owe money to. It's a liability on the balance sheet. Here's our balance sheet equation. So if we've paid cash, cash will decrease by the amount, 200. But now we're settling a liability. So the second part of that double entry is that payables, which is recorded within liabilities, also decreases by 200. It's the same movement by the same amount on each side of the balance sheet. This time, the net effect is that the balance sheet size is reduced by the size of the transaction. Total assets decreases and total liabilities also decreases by exactly the same amount. Let's look at another example. We sell 500 of goods on credit. So that means we make sales to customers and we tell them that they don't have to give us the cash now. We might offer them credit terms, 30 days to pay us. This time there is no cash impact. Instead, we have to increase an account known as trade receivables by 500. Trade receivables is also known as trade debtors, people who owe us money, shown as an asset because we're expecting them to pay within whatever our credit terms are. If we've sold to them, then we can record that sale in our income statement. And any transaction that affects the income statement, of course, also affects bottom line net profit, and that net profit via retained earnings feeds into equity. And so equity within the balance sheet also increases by 500. So to summarize, receivables is an asset account, revenues and expenses are part of profit and so counted as part of equity for the equation. And the net effect is that the balance sheet size increases by the amount of the transaction. Both total assets and total liabilities increase by the same amount. We also have to allow for the fact that the goods we sold cost us something to buy. Let's say the goods sold previously were purchased for $275. Now we've got to record the fact that we no longer have that inventory on our balance sheet. So inventory needs to be decreased by $275 and retained profits correspondingly decreased by $275. In fact, we'll expense the inventory through an expense line known as cost of goods sold expense within the income statement. You can see then in the income statement we will show revenue of 500, costs of 275, and the net result, our net profit, will be 225. Overall then, assets will increase by 225 and retained profits will increase by 225. The net result of both transactions. Let's look at paying a dividend for 1,000 in cash. Cash decreases by 1,000 and retained profit also decreases by 1,000. Now note that we wouldn't see the dividend as an expense line in the income statement. Dividends are always shown as directly reducing retained earnings. So we would see that in the statement of changes in equity. What's happened to the balance sheet? Well, overall the net effect is that the balance sheet size has reduced. Total assets is down by 1,000 and total liabilities and equity is also down by 1,000. What happens if the company borrows 500 of new long-term debt? Assets increase by 500 and long-term debt liabilities also increase by 500. We've got one asset account, one liability account, both of which are increasing, and the overall balance sheet size increases. Finally, we settle a 750 trade payable by issuing a long-term note. So rather than paying the trade payable from existing cash, we borrow money to be able to pay them. So payables decrease by 750, the amount that we've paid off. That's a current liability, and it's replaced with a non-current liability, an increase in a long-term note of 750. So we've got both items as liability accounts, repaying one debt by raising another. And here the net effect is that the balance sheet size stays the same, but there's a movement out of current liabilities and into non-current. So what are debits and credits? This is a language used by accountants which you may have heard before. Debits and credits are a way of describing whether an account within the financial statements has increased or decreased. Every transaction creates matching debits and credits, which are always equal. And the type of account that you're increasing or decreasing determines whether you would describe that change as a debit or a credit. Some people think that credits are good and debits are bad, or even the opposite, that debits are good and credits are bad. But in fact, neither is true. There are simply a set of rules to apply. Debits describe an increase in assets, dividends or expenses, and so intuitively the company is using resources when these accounts increase. Credits reflect increases in liabilities, capital or income. So intuitively the company is receiving resources when these accounts increase. Another way of looking at this is that assets on the left of the accounting equation increase with debits and decrease with credits. And the opposite true is liabilities and equity on the right side of the equation increase with credits and reduce with debits. You can see that graphically below. Now try the following exercise. Fill in the table to complete the dual effects of each one of the following transactions. So if you purchase a piece of machinery for cash, PPE goes up and cash goes down. Both of them are assets in the balance sheet. If you receive cash from a customer, cash goes up and accounts receivable goes down, assuming they're paying off the debt they owe you. If you borrow money from the bank, cash goes up and debt goes up. So we've got one asset going up and one liability going up. If you settle an accounts payable balance, then cash decreases and the accounts payable liability also decreases as you pay it off. If you pay staff wages, cash decreases and salary expenses go up. If you write off obsolete inventory, that means you write down the value of the inventory because you're not able to sell it anymore and charge that expense through cost of goods sold. If you make a cash sale, cash goes up and your revenue in the income statement goes up, which remember affects retained earnings and hence equity in the balance sheet. And if you make a sale on credit terms, there's no cash impact. Revenue does go up in the income statement to recognise that sale, but until the cash comes in, you hold the amount owed as an accounts receivable balance on the balance sheet.